In this video, we will discuss depreciation expense. Depreciation is the process of allocating to expense the cost of buildings and equipment over their useful life in a rational and systematic manner. This allocation properly matches expenses with revenues because it distributes the asset's cost to the periods that generate revenue from its use. Depreciation does not apply to land. Let's review depreciation expense and accumulated depreciation. Depreciation expense is reported on the income statement, whereas accumulated depreciation is reported on the balance sheet. Depreciation expense reduces net income for the amount of depreciation for that period. Accumulated depreciation is a contra asset account. It reduces fixed assets or property, plant, and equipment. The amount reported on the balance sheet is net book value, which is simply the difference between the cost and accumulated depreciation. Depreciation is based on three factors. The first one is cost, which was covered in the previous video. The second factor is useful life, which represents management's estimate of the asset's useful life to the company. Lastly, salvage value, also referred to as residual value, represents management's estimate of the asset's value at the end of its useful life. It reflects the amount the company expects to recover upon disposal of the asset. Although a number of methods exist, depreciation is generally computed using one of these three methods. In this video, we will discuss straight-line depreciation because it is the most widely used method. Under the straight-line method, an equal amount of depreciation expense is recorded each year. The formula for straight-line depreciation is cost minus salvage value divided by the estimated useful life in years. To illustrate, let's assume a delivery truck was purchased for $36,000 on January 1st. The truck has an expected salvage value of $6,000 and an estimated useful life of 8 years. To calculate depreciation, you simply take the cost of $36,000 and subtract the salvage value of $6,000 and divide that by 8 years to arrive at depreciation expense of $3,750 per year. In year 1, the depreciation expense and accumulated depreciation are the same amount. The book value is $32,250, which is simply the difference between the cost of the asset and accumulated depreciation. The journal entry results in a debit to depreciation expense for $3,750 and a credit to accumulated depreciation for the same amount. It is important to note, depreciation expense is the same amount each year. In this example, it's $3,750. Accumulated depreciation will increase and the book value will decrease by this amount each year. Lastly, the book value at the end of the useful life is equal to the salvage value, which is $6,000.